Hi, and welcome to this short video presentation that I call Easy Candles. 80% of the benefit with only 20% of the work. And of course, remember, everything in this presentation is for educational purposes only. There's never a recommendation to buy or sell anything. I wanted to talk about candles. Candlesticks is a way of representing stocks on a stock chart. Pretty much any stock chart application will allow you to configure the view to be candlesticks. Candlesticks were invented by the Japanese rice farmers hundreds of years ago, and they worked with these candles and they priced there and looked at the flow and prices of rice, and they did all their charting by hand using these patterns that are referred to as Japanese candlesticks. Typically, there are two kinds of candles. There are down candles, a down day, which says if a stock price opens at the top of this red rectangle and closes at the bottom, this would be a red candle because the day goes from a higher price and closes at a lower price. In addition, the high for the day could be up here and the low for the day could be down here. And so the wick for this candle, this stick that's sticking up and down, represents the high and the overall low for the day. Likewise, if you have a white candle, or more officially a hollow candle, this white candle shows you that the stock opened down here at the bottom of this rectangle. It closed at the top, but between when it opened in the morning and closed at the end of the day, it went higher up to here, and at some point it went lower down to here. So the down day candles are typically red, and the up day candles are typically white. Now you will find some stock charting programs that have up days that are green and red, and you will find some that are white and black if they're black and white charts. But in addition, if they are in color, sometimes you will have a program that has red candles for down days, but occasionally you'll have a black candle, which is also a down day, but it's down, it gaps up and it comes down from there, but ends up staying above the day previously. Likewise, a hollow red candle is a hollow candle, so it's an up day, but it didn't go up as high as the previous day. So those two candles, the odd candles that you would have in a charting program that has four types of candles, they're pretty rare, but you will see them from time to time. So if we have a basic candle, this stock would open at the high. That's the open. It might go up to a high represented by the top of the wick. Then it might go down to the low of the day represented by the bottom wick, and then wander around in between and end up at a close, which corresponds to this level right here at the bottom. Similarly, an up day opens at the bottom of the real body. It might go down and it might go up, but it ends up at the close for the day, which is right here at the top of this real body. So that's what the candle structures look like. So what do we do with that information? Well, first we've got to recognize that there are lots of different shapes and sizes of candles, and there are lots of different patterns of candles. And we can look at, here's just a sampling of some of the candlesticks that you might do. Now, the candlestick purists would say, oh, you've got to memorize all of these candles. And here's a chart off of Thinkorswim's charting pattern that shows all sorts of candle patterns, like the bullish kicking and the bullish tri-star and bullish harami cross. You don't need to know all of those patterns. What you need to be able to realize is you need to understand why the patterns are the way they are and what's going on behind the patterns. So let's look at some of that. On the left, we see a period of low conviction. See, the stock opened at one price, it wandered around a little bit, and it closed about the same price. Nobody's really excited about where this stock should go. It doesn't go up, it doesn't go down. On the next candle, about the same thing. No conviction. It's just wandering around. The third candle got a little bit of conviction, so it looks like we're heading down, but then the next day, not a lot of conviction. So this low conviction area, a candle that's shaped like this with no conviction is referred to as a doji. It opens and closes about the same place and has a little bit of a top and a little bit of a bottom. And some people will even refer to a collection of these as spinning tops, children's toys spinning around. This represents a period of low conviction. In contrast, if we have a series of big, white, full-bodied candles going up, this is often referred to as three soldiers. 3 of these in a row is a strong, high conviction signal. So if you see lots of big candles in a row, lots of strong conviction. So it helps to know whether a stock is having some strong conviction or not. You may see a stock run up over the course of a couple of weeks with lots of big candles, and then it gets to a place and it just sits. So it might go up like these 3 soldiers, and then it comes into a period where it just sits in an area like this. So we had lots of conviction, and it got to a place where people are saying, okay, now we're just sitting trying to figure out where we're going to go. That's the period of low conviction. And often you will see periods in the market where you've got high conviction for a week or 2 or 3, and then you've got low conviction for a little while and may trade in a small range. So here's what we've referred to as a reversal pattern. Here we've got lower conviction area here, and then we've got some strong conviction with these high, big white candles. And you get to a candle here that's got a long wick on the top and a very narrow body here. And what this candle does is this is saying, okay, here we're at low conviction, and then suddenly, oh my, we're really excited, and it gets to early afternoon, and they say, no way, this is just too high. We can't go this high. We've got to turn around and we come back there. And this candle will mark the top of this pattern because people thought we were going to get up here, and then everybody said, no, nope, we're turning around. And then if the next day we get a candle down here, that's additional emphasis to this reversal pattern. So look at this candle right here. This is referred to as a shooting star. It looks kind of like a meteor falling out of the sky. That represents the top of a trend. As long as you have good follow-through, this represents the top of a trend. So at candle 1 is a strong going straight up. Candle 2 is going up. Candle 3, the shooting star, goes up and it comes back down and closes down here near where it started. And then candle 4 is down below that, showing some additional follow-through from that shooting star. Here's another reversal pattern to the downside. We've got candles going down, big red candles. These are like the 3 soldiers that we saw going up, the 3 white soldiers. This is referred to as 3 black crows from when stock charts were black and white. These are the 3 black crows, but it ends up in a candle that looks like this. This would be referred to as a hammer with a narrow body and a long tail going down here. So the stock went way down and it came back up and ended about where it was. Now this is actually not quite a hammer because it has a tall wick up here, but nevertheless this kind of pattern where you go all the way down and come back up, especially when it's followed by a strong white candle, this represents the bottom of a downtrend. And you see all these candles squiggling. Here's a number 2, strong white, and then you get this one, the hammer-like candle that shows lots of indecision. We went down and we came back up, and then a strong follow-through with candle number 4. So here's an example from a real stock chart. This is Apple from August of 2011. And look at this trend that we've got going here. We came up to this point, and then we started heading down, and we wandered a little bit, and we headed down some more. And then we got to this point right here, and here's a pretty good hammer. This was at the bottom of this downtrend, and it went down and it came back up and closed there, and it was followed by a big white candle. So this three candle pattern right here shows a big down day, a gap down to a hammer shape, long wick, narrow real body, followed by a strong up candle. These three candles together is a great reversal signal, especially with this hammer right here. Now it's important to note that if we look at these three candles, big down day, a hammer, followed by an up day, if we combine these three candles, where does this period start? It opens right here at the top of this, it closes right here, and it has a long trip down to the bottom. So here is, if we combine these three candles into one candle and have a 3-day candle, it's a big fat hammer with a narrow body and a long tail, and this is a great reversal pattern because it opened here, it went all the way down and came right back up. So if you look at patterns like this 3-day pattern as a single candle, if you see hammers like this, that's a good sign that we're at a reversal pattern. Of course, it doesn't always work, but it's a good reversal signal. Now, it's worth pointing out that I talk about daily candles, and this chart that you see from Apple is a daily chart, but you can have candles of any period. It's often that you would look at weekly candles to get a look at a longer term trend. And if you're a day trader, you might look at 10-minute candles, where you look at the action within the day. So the period of the candle doesn't really matter. Daily charts are certainly the most common, but the patterns that you see are the same whether it's weekly, daily, or 1-hour candles or 10-minute candles. They're all pretty much the same. Here's another pattern. This is referred to as a bearish piercing pattern. The second candle, this red candle that I highlighted in yellow, starts up above the white candle and it pierces. It goes all the way down past the midway point of this candle here. Now, if you combine these two candles into one candle, here's what it looks like. It looks like pretty much like a shooting star candle. And so if we had this pattern and there was follow through down here with a continuation to the downside, these 2 days here would take the place of a shooting star because this is a 2-day shooting star, and that's what it looks like. So if we get some follow through there, we would have a reversal pattern from the top of this, from this trend up to the upside, a little bit of indecision, and then this big reversal pattern here. So while you might want to remember the name bearish piercing pattern, you can just look at this as a reversal, this pair of candles as a reversal pattern. So remember that you can combine candles into a 2-day candle, if you will, and you can see what some of the patterns mean. Here's a pattern that is often referred to as a bullish engulfing pattern. And if you look at a bullish engulfing pattern and combine these two into one candle, here's the open, here's the low, here's the high, and the close are at the same time, and these combined equals a pretty hefty hammer. So a bullish engulfing pattern is really a 2-day hammer. And remember, hammers and shooting stars are the two biggest signals for a reversal pattern. And so you can combine many different 2-day patterns and even 3-day patterns into reversal patterns that, if you combine them, look a lot like shooting stars and hammers. So look at your charts, set your charts to candles, and start to look at some of the patterns that I've talked about in this chart, and refer to the book. There's more information on candles and trading and technical analysis in the book, and I'm sure you'll enjoy looking at that. So for more information, check out the book or check out the website. Thanks a lot, and we'll talk to you in the next video.